Good evening, viewers. I'm your host, Alois Vinga, business reporter with newzimbabwe.com. Joining me in the studio is Mr. Denford Mutashu, president of the Confederation of Zimbabwe Retailers.
Thank you for inviting me, and a very good evening to you, our viewers.
Mr. Mutashu, we are hosting you at such a time when retailers have been increasing prices. Seems like you're making a lot of money, is it?
Well, retailers do not increase prices, as it were, and a lot of retailers have maintained their normal markups. Unfortunately, the challenge that we are facing right now is the issue of shortages of selected basic commodities, and when demand outstrips supply, I think it is just a basic economic issue. There is bound to be some price increases. Basically, we can locate that from the pronouncement that was recently made by the two policies, the midterm monetary policy as well as the fiscal rather fiscal stabilization and rather roadmap by the Minister of Finance, Professor Mutashu. We now, than was expected, there has been a separation of the RTGS, FCA RTGS from the FCA Nostro. So what it basically has done is to make probably people panic and believe that there has been a devaluation of the RTGS value. There has also been a devaluation of the bond note, and it has also pushed foreign currency black market premiums, and it is actually basically as you may be aware, local manufacturers require foreign currency for them to be able to produce, since the bulk of our raw materials is actually imported from South Africa and China, etc. So in such a scenario where a manufacturer does not have consistent, reliable supply of raw materials owing to the shortage of foreign currency, it creates a deficit in terms of the supply of goods onto the market, while demand for products like those basics that I've mentioned, cooking oil, sugar, meal, salt, meat, chicken, etc., has actually been going up. At some stage, I think about a month ago, we got reports that the production of livestock, like the chickens that got onto the market, is increased by about 30%, which means that Zimbabweans are consuming more than they were consuming in the previous years. And it is an unfortunate development right now that prices are going up, and those prices that have gone up largely have got a huge import component.
Just to get clarity from you, the tax increment is a 2 cents per every dollar transaction, but we are seeing prices going far beyond than the 2 cents. What is your explanation to that?
Well, the better interpretation rather is not to zero in on the 2 cents per dollar, transacted via the platforms of on the mobile platforms as well as electronic platforms, because that is not the only component that has pushed prices upwards. The real issue here is the issue of the separation of the FCA accounts, which has devalued the RTGS balance. Remember, the majority of companies have been sourcing foreign currency from the parallel market. But today, as I was coming here, I passed through one of the markets, Roadbot, and they're telling me that it's now at above 300%. So when you have got such a scenario, that parallel market has largely become the de facto reliable market for foreign currency. Unfortunately, right now it's actually drying up, owing to the huge demand, the huge influx that has been caused by people wanting to offload their RTGS balances and store the money in the hard currency, which they believe it can actually be quite consistent, rather constant in terms of maintaining value. So to say that retailers are increasing prices wantonly or profiteering. I don't think that is a justified statement. In any case, what we have noticed is that some selected retailers have actually decided not to continue trading because they want to preserve the value of the stock that they have. And also some have decided not to continue trading because quite a number of manufacturers have stopped supplying. Local manufacturers have stopped supplying. So it may not be an issue of, if we try to zero in on the retailers only without going back into the value chain, I think we will be creating more problems and looking at the symptoms.
There is also this issue where just this afternoon we received a statement from Cephas Wilma, the largest manufacturer of cooking oil, stating that their prices for cooking oil have not changed from $3.70. But we are seeing some retailers selling such kind of commodities way far above the stipulated recommended price. What is your take on that?
That statement is laughable because, how does someone come up with such an unfortunate statement in an environment where they are struggling to catch up with demand? And this is the reason why, as retailers, we are saying, if we go back to 2015, prices had actually been going down, and we actually went through a depression, as it were. And now prices have started appreciating at a much faster rate because of the shortages. And back then, we didn't have shortages of basic commodities. We didn't have any shortages of any products. Otherwise, the issue was how do we stimulate demand? But right now, it's the other way around. Demand all of a sudden, because of the money that was created and pumped into the system through the RTJ system, through the treasury bills, it has created huge demand, and the marginal propensity to consume and to purchase, especially basic commodities, has just shot up. So in such a scenario, we have oil processors that are largely relying on the drip feed in terms of the allocation of the foreign currency, even without them growing themselves out of that drip feed to go and support the soybean farmers so that we can domesticate the sourcing of the raw materials. So for them really to come out and try and accuse the retailers of profiteering is unfortunate, because as retailers, I think we have a very good relationship with the majority of the local suppliers, having taken a very difficult decision to deliberately support the local manufacturers so that they could be able to capitalize, retool, and be able to stand on their feet and compete with the imports, and supporting the initiatives like import substitution, SI 64, which is now SI 122, was a deliberate decision by the local retailers to try and support the local reindustrialization efforts. So I'm actually not happy that they try now to force the issue on the retailers, as it were, or to shift blame. They should come out and be truthful and indicate that while they've received support from government, they've not been able to live up to the challenge of in ensuring consistent supply of the product because of the high demand. And we are basically saying, as retailers, we don't mind at this particular time to actually receive a batch of imports of those products that are in short supply, so that we help stabilize the prices, we help ensure that consumers are saved in terms of product availability. The reason why consumers are panicking is because of those shortages that have actually been created, and sometimes they become very artificial, especially in an environment where social media has been a buzz. Actually, people creating groups of cooking oil group, cement group, etc., which is quite unfortunate, because what is communicated cannot be controlled through those platforms, and it has also created a lot of anxiety. So we are ready, and we've always been ready. We've always supported the local industry, and we've always supported all the initiatives that government is come up with. We remain very committed to do so, and at the present moment, the challenge that the economy is facing is shortage of foreign currency. It has not been coming consistently, it has not been allocated consistently, and causing those gaps in terms of supply of products. So during the time that a manufacturer or an oil processor has not received foreign currency, that dip in terms of the supply would actually then outstretch the quantities that the retailers receive. And in any case, this is the reason why a lot of retailers are rationing.
Okay, Mr. Mutashu. Now, coming back to this issue of foreign currency, just this afternoon when you carried out our own brief survey, we discovered that some retailers are beginning to charge these goods or basic commodities in foreign currency. Is this at the direction of CZR, or what is your take on this?
It is not a directive from the Confederation of Zimbabwe Retailers, but it is just a response or a reaction to the separation of the two accounts, where we now have the FCA Nostro and the FCA RTGS. How it has been interpreted is what has caused the situation that we have right now. The main worry is the cost of replacement to replace the stocks after you have sold them through those platforms. This is why some that I've indicated have decided actually not to continue selling, because they are saying, if, for example, you've got stocks worth, say, 1,000, and you sell those stocks, you get your profit of, say, about $100. That's 1,100, right? And then the next time you go back to a supplier, because the majority of the manufacturers, literally, after the announcement of the 2 cents per dollar tax, they increased prices. They send us price increases, and we've got confirmation of those price increases. So we are not talking about something that is not happening. So they send us price adjustments notices, and in any case, we are price takers. We simply comply. So what basically is happening is that the situation that we have is arising out of lack of confidence. And that lack of confidence, actually, I can track it back to that time where the finance minister at the swearing in, he indicated that he was going to decimate the bond note. He was also going to get us into the Rand Monetary Union or otherwise. So that also had a knock on the value of the RTG, rather of the RTGs, as well as the bond note. Remember, the bond note is not a currency that people had always wanted to have on board, but it was because of convenience that it brought. They could not escape that. They ended up accepting it. For example, exporters, actually, we received news from the RBZ that they actually benefited and have been able to export about 12.6 billion. And that of course, is something that should be commended. But for us then, just to wake up one day and say, the bond note is going, it creates a lot of unnecessary anxiety, because people were now anticipating to see the bond note going, because the time frame that was given was up to December, and everyone who was holding on to the bond note panicked, because they didn't know whether it was going to be the 31st of December or whether it was going to be next week. So that actually had a serious knock on the value of the bond note. This is the reason why a lot of people now were no longer accepting the bond note.
Mr. Mutashu, just yesterday the RBZ governor announced that you had now begun to dip into the $500 million credit facility, and had allocated 41 million towards the importation of fuel, and then the rest will be going towards basic commodities. How has been the progress in accessing that fund as retailers?
As retailers, I don't think we have received that fund, because I think critically it has been received by selected manufacturers of key basic commodities, and which is actually quite progressive in terms of the priority list, as well as the importation of fuel. We welcome that. Where we've got a problem is we should not get to a point where we see fuel queues, because that actually affects perceptions. The people would then panic if they see that fuel queues are resurfacing, because it is almost the same template that we saw in 2008. Remember, some of us have got a lot of experience, and we were part of that particular era where the economy went into and total madness in terms of the way things were happening. So we are quite experienced in as far as then looking at the trends and being able to interpret them. So basically, what has simply happened is that consumers, they would tell you that once bitten, twice shy. In 2008, we started seeing some fuel queues. Before it then migrated into the shortages of basic commodities, and before we knew, we started having a parallel market or a black market for fuel and the basic commodities. So it is a pattern that people are quick to relate to 2008, and even the separation of the FCA Nostro and from the FCA RTGS is also interpreted as if the same situation that happened when people woke up to their bank accounts with literally we can say the money was gone. So people are actually linking that to what happened. But of course, we can assure the people that right now the situation is different, because we've got a lot of companies, a lot of manufacturers that have come on board since the introduction of SI 64, which is now SI 122. And we actually have a lot. What they simply need is just the support. So we are saying once we support the supply side, then we are assured of consistent availability of products on the shelf. And in any case, that is an environment that any retailer or wholesaler would wish to have. It is also not good for us, or it is not convenient for us even to buy goods from out of the country. It is convenient to go to Workington, if you are in Blaawai, the local industry, you can rush there and pick the boxes that you want and stock. But if you run out when you are relying on a South African market, it becomes very difficult. So for retailers and wholesalers, it is convenient that we buy from local. And it is also critical and integral at this particular time that government looks at how they place their priorities. We should never run out of, or rather experience shortages of basic commodities. We should also never experience shortages of fuel.
Okay, just on this issue of priorities, how is government been picking this priority list according to the way you perceive it as sees it?
I think they prioritize fuel and other key products like wheat. They also prioritize soya, so that we have a consistent supply of cooking oil. Unfortunately, when there is panic buying, it makes it very difficult then for the two to match, or rather to have an equilibrium between supply and demand, as it were. But otherwise, it has been going on very well. And even this 500 million facility, it is quite welcome, though it will be a drop in the ocean. Remember, a lot of companies currently are owing their external suppliers, and I think collectively it should be above 500 million. So what basically we are saying is that let's help manufacturers, let's help industry, let's help in terms of procuring of raw materials. And we are quite happy that even in terms of the press statement that Dr. Mangojka released yesterday, it is actually then indicating that the 500 million will be allocated to the importation of key raw materials. We don't want a situation where even pharmacies run out of product, run out of medicines, because a lot of pharmacies right now are empty. So it is not a situation that we would want to obtain. And you would then see a scenario where a lot of people would go into the pharmacy, they swipe for the tablets or whatever it is, and then they'll be selling those same tablets outside, which is actually posing another serious risk to the health of the nation.
You see, Mr. Mutashu, what worries members of the public the most is that the rate at which the prices are being increased is so fast. You find that some retailers are now being accused of removing price tags, some price going up at an hourly rate. What is really going on? What is causing that? Are we saying that the rate at which the parallel market is also increasing their rates is at such a fast speed?
Yes, of course. I'm sure you know that this parallel market was actually below 100 at some stage, but now we're talking of 300%. So any side business would chase it, because that is the value that we checking or rather we are premising the stock value against. So we cannot continue to premise the value of the stock that you are holding on the RTGS balance or the bond note anymore, because it keeps losing value, and it keeps decimating in terms of its value against the appreciating hard currency, which is actually literally not even there. Even on the parallel market, the hard currency is now very scarce.
Okay, Mr. Mutashu, as we conclude, what is your final word to the authorities in Zimbabwe, to the members of the public who look upon retailers to access the basic commodities?
We can assure the public that there is a lot of engagement that is taking place, and goods will be available again on shelves. And also to government, we always encourage dialogue, especially on critical issues like the 2% tax, as well as the separation of the FCA accounts, which has caused a lot of anxiety on the market. But of course, to the retailers and wholesalers, we always encourage them to actually be restrained. There is no need for them also to increase prices unjustifiably, and take advantage of the consumers. And to the consumers, we can encourage them not to panic, and they should desist from buying from the parallel market. They should always wait until the formal retailers have got product, other than for them to be fleeced by those opportunists that are taking advantage of the situation. And yes, the issue here is the issue of availability of foreign currency. It is quite integral, it is quite key. As long as foreign currency is available, raw material procurement is consistent and reliable, we will not have any shortages on the market.
Thank you very much, viewers who were tuned in to watch this program. I had Mr. Denford Mutashu, President of the Confederation of Zimbabwe Retailers, who was just giving us an insight on what is happening with the price dynamics currently being experienced in Zimbabwe.